Question 1. A registered representative proposes sending a research report to a client. Which of the following statements regarding the principal's review and approval of the report is most accurate? A. The principal must approve the report prior to its first use if it is considered retail communication. B. The principal's approval is not required if the report is sent only to institutional clients. C. The principal may approve the report after its first use, provided a record is maintained. D. The principal must only review the report if it contains specific recommendations for individual securities. Answer: A. The principal must approve the report prior to its first use if it is considered retail communication. FINRA rules require a principal to approve all retail communications, including research reports, before they are distributed to the public. Retail communication is defined as any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period. This pre-use approval ensures the communication is balanced, fair, and not misleading, safeguarding investors. For instance, a report recommending a stock to numerous individual clients needs principal sign-off before being sent out. Always remember, protecting the public through proper oversight of communications is a primary principal responsibility. Question 2. An associated person of a FINRA member firm wishes to engage in an outside business activity, OBA. Which of the following is the most appropriate action for the associated person to take regarding this OBA? A. The associated person must obtain written approval from FINRA prior to engaging in the OBA. B. The associated person must provide written notice to the member firm prior to engaging in the OBA. C. The associated person may engage in the OBA without notice if it is unrelated to the securities business. D. The associated person must only notify the member firm if the OBA involves compensation. Answer: B. The associated person must provide written notice to the member firm prior to engaging in the OBA. FINRA Rule 3270 requires an associated person to provide written notice to their member firm before engaging in any outside business activity, whether compensated or not. The purpose of this rule is to allow the firm to assess potential conflicts of interest, ensure the activity does not interfere with the associated person's responsibilities to the firm, and monitor for any violations of securities laws. For example, if a registered representative plans to teach a fitness class on weekends, they must notify their firm in writing beforehand. Remember that transparency with the firm regarding outside activities is key to maintaining compliance and avoiding conflicts. Question 3. A branch office is designated as an Office of Supervisory Jurisdiction, OSJ. Which of the following is a mandatory responsibility of a principal located at an OSJ? A. Conducting an annual independent audit of the firm's financial records. B. Reviewing and approving all customer new account applications. C. Establishing and maintaining a business continuity plan for the entire firm. D. Enforcing the firm's written supervisory procedures and addressing customer complaints. Answer: D. Enforcing the firm's written supervisory procedures and addressing customer complaints. An Office of Supervisory Jurisdiction, OSJ, is a critical location for a broker-dealer's supervision, and a principal at an OSJ has specific responsibilities for enforcing the firm's written supervisory procedures, WSPs. This includes the responsibility for resolving and addressing customer complaints relating to the activities of that OSJ and its associated persons. While other activities like new account approval are important, enforcing WSPs and handling complaints are core duties unique to a principal at an OSJ. Consider that the principal at an OSJ acts as the frontline supervisor, ensuring that all activities conducted under their purview adhere to the firm's policies and regulatory requirements. Question 4. Which of the following actions is required when a customer account is opened and an associated person is permitted to share directly in the profits or losses of the account? A. The associated person must receive written permission from FINRA prior to sharing. B. The associated person must have a written agreement with the customer, and the sharing must be proportionate to the associated person's financial contribution. C. the associated person must obtain the member firm's oral approval, and the customer must be institutional. D. The associated person may share if the customer provides written consent, regardless of the associated person's financial contribution. Answer: B. The associated person must have a written agreement with the customer, and the sharing must be proportionate to the associated person's financial contribution. FINRA Rule 2150, formerly Rule 2150, prohibits associated persons from sharing in the profits or losses of a customer's account unless specific conditions are met. These conditions include obtaining written authorization from the member firm, having a written agreement with the customer, and ensuring that the sharing is proportionate to the financial contributions made by the associated person to the account. For instance, if a representative invests $1,000 in a client's account, they can only share in 1% of the profits or losses if their $1,000 constitutes 1% of the account's total capital. Remember that this rule is designed to prevent conflicts of interest and ensure fairness. Question 5. A FINRA member firm must conduct an annual compliance meeting for all registered persons. Which of the following topics must be covered during this meeting? A. Only changes to the firm's written supervisory procedures, WSPs, for the year. B. Any disciplinary actions taken by FINRA against other member firms. C. Relevant regulatory elements of the continuing education program. D. Compliance with applicable securities laws and regulations, and the firm's internal policies. Answer: D. Compliance with applicable securities laws and regulations, and the firm's internal policies. FINRA Rule 3110 requires member firms to conduct an annual compliance meeting for all registered persons. The primary purpose of this meeting is to review and reinforce compliance with applicable securities laws and regulations, as well as the firm's internal policies and procedures. This ensures that all registered personnel are up to date on their obligations and the firm's expectations, helping to prevent violations. For example, topics covered would typically include anti-money laundering, AML, updates, new communication rules, or changes in how the firm handles customer complaints. Think of it as a mandatory annual refresher to keep everyone on the same page regarding their compliance responsibilities. Question 6. A principal is reviewing a customer's options account application. Which of the following is a primary consideration for the principal in approving this account? A. The customer's prior experience with commodities trading. B. The customer's investment objectives, financial situation, and knowledge of options. C. The customer's willingness to sign a waiver acknowledging the risks. D. The customer's intention to use the account solely for income generation. Answer: B. The customer's investment objectives, financial situation, and knowledge of options. When reviewing an options account application, a principal's primary responsibility is to ensure that options trading is suitable for the customer. This involves carefully assessing the customer's investment objectives, e.g., speculation, hedging, their financial situation, e.g., net worth, liquid assets, and crucially, their knowledge and experience with options. For example, if a customer with limited income and no prior options experience wants to engage in complex speculative option strategies, the principal might deem the account unsuitable. Always remember that suitability is paramount, especially for complex products like options, to protect the client. Question 7. Under FINRA rules, what is the maximum gift value an associated person can give to a person connected to the business of another member firm in a single year? A. $50. B. $100. C. $200. D. $500. Answer: B. $100. FINRA Rule 3220, regarding influencing or rewarding employees of others, prohibits an associated person from giving anything of value in excess of $100 per year to any person where such payment relates to the business of the recipient's employer. This rule aims to prevent undue influence or the appearance of impropriety between firms and their employees. For instance, a representative cannot give an employee of another firm a gift worth $150 in a calendar year, as it exceeds the $100 limit. This modest limit emphasizes ethical conduct and fair competition within the industry. Question 8. A principal discovers that an associated person has engaged in excessive trading in a customer's account. This practice is also known as A. Front-running, B. Churning, C. Marking the close, D. Capping. Answer: B. Churning. Excessive trading, or churning, occurs when a registered representative exercises control over a customer's account and engages in transactions that are excessive in size or frequency given the customer's investment objectives. This is generally done to generate commissions for the representative, rather than to benefit the customer, and is a serious violation of suitability rules. For instance, if a conservative investor's account shows dozens of trades in a short period, incurring significant commission costs that erode returns, this could be evidence of churning. Always prioritize the customer's best interest. Excessive trading for personal gain is strictly prohibited. Question 9. Which of the following is not required for a principal to approve the opening of a new customer account? A. The customer's name and address. B. The customer's social security or taxpayer identification number. C. The customer's financial statement signed by a CPA. D. The customer's investment objectives and risk tolerance. Answer: C. The customer's financial statement signed by a CPA. While a principal must collect significant information to approve a new customer account, such as the customer's identity, investment objectives, and financial situation, a financial statement signed by a certified public accountant, CPA, is not a mandatory requirement for opening every account. Firms typically gather information like employment, annual income, net worth, and risk tolerance to establish suitability, but specific CPA-certified financials are usually only required for certain sophisticated or high-net-worth accounts, or specific product types. Remember that the core goal is to understand the customer well enough to ensure suitability, not necessarily to demand a CPA's signature for every account. Question 10. A principal is reviewing the firm's anti-money laundering (AML) program. Which of the following is a key component required for an effective AML program? A. Appointment of an independent external auditor for all AML reviews. B. Annual filing of a Suspicious Activity Report, SAR, with FINRA. C. Designation of an AML compliance officer and ongoing training for employees. D. Automated reporting of all cash transactions over $5,000 to the Treasury Department. Answer: C. Designation of an AML compliance officer and ongoing training for employees. A robust anti-money laundering (AML) program, mandated by the Bank Secrecy Act and FINRA rules, requires several key components. Among them are the designation of an AML compliance officer responsible for implementing and monitoring the program, as well as providing ongoing training to all relevant employees. This ensures that staff can identify and report suspicious activities. For example, employees must be trained to recognize red flags like unusual cash deposits or frequent transfers to high-risk jurisdictions. Understanding these foundational elements of an AML program is critical for supervising compliance. Question 11. Which of the following statements best describes the requirement for a FINRA member firm regarding its written supervisory procedures, WSPs? A. WSPs must be updated monthly to reflect market conditions. B. WSPs must be maintained at every registered representative's residence. C. WSPs must be tailored to the firm's business and regularly reviewed and updated. D. WSPs are primarily for the benefit of regulators and do not need to be disseminated to all employees. Answer: C. WSPs must be tailored to the firm's business and regularly reviewed and updated. FINRA Rule 3110 requires every member firm to establish and maintain a system to supervise the activities of its associated persons, which includes the creation and enforcement of written supervisory procedures, WSPs. These procedures must be reasonably designed to achieve compliance with applicable securities laws and regulations, tailored to the firm's specific business lines, and regularly reviewed and updated to reflect changes in rules, firm structure, or business practices. For instance, a firm dealing heavily in options would need detailed WSPs for options supervision. WSPs are the firm's internal rulebook for compliance and must be accessible and understood by relevant personnel. Question 12. A principal is tasked with supervising the sale of mutual funds. Which of the following is a primary concern regarding disclosures to customers? A. Ensuring the customer receives only the fund's summary prospectus. B. Providing disclosures about the fund's expense ratio and sales charges. C. Highlighting only the fund's past performance to attract investors. D. Guaranteeing a minimum return based on historical data. Answer: B. Providing disclosures about the fund's expense ratio and sales charges. When supervising the sale of mutual funds, a principal must ensure that customers receive adequate and accurate disclosures regarding all relevant fees and charges. This prominently includes the fund's expense ratio, which represents annual operating costs, and any applicable sales charges, such as loads. These disclosures are crucial for investors to understand the true cost of their investment and are mandated by regulatory requirements to ensure transparency. For example, a mutual fund may have a front-end sales charge of 5% and an annual expense ratio of 1%, which must be clearly communicated to the investor. Always remember that full disclosure of costs is fundamental to investor protection. Question 13. In the event of a significant business disruption, such as a natural disaster, a FINRA member firm's Business Continuity Plan, BCP, must address which of the following? A. Only the firm's ability to maintain physical access to its primary office. B. How the firm will communicate with employees, regulators, and customers. C. The process for liquidating all customer positions immediately. D. A guarantee of zero disruption to all customer services. Answer: B. How the firm will communicate with employees, regulators, and customers. FINRA Rule 3110 requires member firms to establish, maintain, and regularly review a business continuity plan, BCP, to address how they will respond to a significant business disruption. A critical component of a BCP is ensuring effective communication channels remain open, especially with employees, regulators, and customers, to provide updates and ensure continued service where possible. For instance, the BCP would outline how the firm will use alternate communication methods, like text messages or a public website, if its main phone system is down. The goal is to minimize disruption and protect customer assets and firm operations. Question 14. Which of the following is a permissible activity for a principal regarding a customer complaint received by the firm? A. Directing the associated person involved to resolve the complaint directly with the customer without firm oversight. B. Delaying the review of the complaint if the principal is busy with sales activities. C. Investigating the complaint, documenting the resolution, and retaining records as per FINRA rules. D. Advising the customer that the firm is not responsible for losses due to market fluctuations. Answer: C. Investigating the complaint, documenting the resolution, and retaining records as per FINRA rules. When a customer complaint is received, a principal has a critical supervisory responsibility to ensure it is handled properly and promptly. This includes thoroughly investigating the complaint, attempting to resolve the issue fairly, documenting all steps taken, and maintaining a record of the complaint and its resolution for the required period, typically 4 years. For example, if a client complains about an unauthorized trade, the principal must investigate the trading records and communicate with the associated person and client. Proper handling of complaints demonstrates a firm's commitment to investor protection and regulatory compliance. Question 15. A Series 10 principal is supervising a registered representative who handles discretionary accounts. Which of the following is a specific risk associated with discretionary accounts that requires heightened principal oversight? A. the customer's inability to provide investment instructions due to travel. B. The potential for churning or unsuitable transactions due to the representative's control. C. The firm's inability to earn commissions on discretionary trades. D. The requirement for frequent communication with the customer about every trade. Answer: B. The potential for churning or unsuitable transactions due to the representative's control. Discretionary accounts grant the registered representative the authority to make trading decisions without specific customer authorization for each trade, meaning they decide the asset, amount, and price. This heightened control creates a significant risk of churning, where the representative excessively trades to generate commissions, or making unsuitable transactions that do not align with the client's objectives. Therefore, principals must implement strict supervisory procedures, such as frequent account reviews, to mitigate these risks. Remember that with greater control comes greater supervisory responsibility. Question 16. What is the primary purpose of a customer's new account form? A. To serve as a contractual agreement for margin interest rates. B. To gather essential information to ensure the suitability of investments for the customer. C. To provide the customer with a list of all available investment products. D. To waive the firm's liability for any investment losses incurred by the customer. Answer: B. To gather essential information to ensure the suitability of investments for the customer. The new account form is a fundamental document for any FINRA member firm, primarily designed to gather essential information about a customer's financial situation, investment objectives, risk tolerance, and experience. This data is critical for the firm and its associated persons to fulfill their suitability obligations under FINRA Rule 2111, ensuring that recommended investments are appropriate for that specific customer. For example, it helps determine if a client is suitable for aggressive growth stocks versus conservative bonds. Understanding the customer's profile is the cornerstone of responsible investing and regulatory compliance. Question 17. Which of the following is a mandatory regulatory filing for a FINRA member firm? A. Annual audited financial statements for public distribution only. B. Quarterly report of all customer complaints to the SEC. C. Focus report, financial and operational combined uniform single, to the SEC. D. Monthly list of all new hires to the Department of Labor. Answer: C. Focus report, financial and operational combined uniform single, to the SEC. FINRA member firms are required to file the focus report, financial and operational combined uniform single, with the SEC, either monthly or quarterly depending on the firm's size and clearing status. This report provides detailed financial and operational information, including net capital computations, to regulatory bodies, allowing them to monitor the firm's financial health and compliance with capital requirements. For example, it outlines the firm's assets, liabilities, and required net capital. This filing is essential for ensuring the financial stability of broker-dealers and protecting customer assets. Question 18. Under FINRA rules, when must a branch office inspection be conducted by a principal? A. Every 5 years for all branch offices. B. Annually for non-supervisory branch offices and triennially for offices of supervisory jurisdiction, OSJs. C. Annually for offices of supervisory jurisdiction, OSJs, and every 3 years for non-OSJ branch offices. D. Only when a customer complaint is received from that branch office. Answer: C. Annually for offices of supervisory jurisdiction, OSJs, and every 3 years for non-OSJ branch offices. FINRA Rule 3110.12, Internal Inspections, mandates that member firms establish and implement a system of internal inspections of their branch offices and OSJs. Specifically, each OSJ and any branch office that supervises other branches must be inspected annually, while all other non-OSJ branch offices must be inspected at least once every 3 years. This regular inspection schedule ensures compliance with internal procedures and regulatory requirements. For example, a principal would visit a non-OSJ branch to review its books, records, and supervisory controls. Regular inspections are critical for maintaining a robust supervisory system. Question 19. A principal is supervising a registered representative's communications with the public. If the communication is considered correspondence, which of the following best describes the principal's review requirement? A. Pre-approval by a principal is always required before sending correspondence. B. Correspondence must be reviewed and approved by a principal within 30 days of its first use. C. Correspondence generally requires review and approval by a principal, but it can be conducted post-use, subject to the firm's written supervisory procedures. D. Correspondence does not require principal review unless it is sent to more than 50 customers. Answer: C. Correspondence generally requires review and approval by a principal, but it can be conducted post-use, subject to the firm's written supervisory procedures. FINRA rules differentiate between retail communication, institutional communication, and correspondence based on audience size. Correspondence, defined as written or electronic communication sent to 25 or fewer retail investors within any 30 calendar day period, generally requires review and approval by a principal. However, unlike retail communication which requires pre-use approval, correspondence can be reviewed and approved either before or after its first use, provided the firm's written supervisory procedures, WSPs, specify the firm's review process and procedures for supervision. For example, a principal might conduct a sampling review of emails sent to a small number of clients. Question 20. Which of the following statements regarding the reporting of disciplinary actions against associated persons is most accurate for a Series 10 principal? A. Firms are only required to report criminal convictions, not civil actions. B. Firms must report disciplinary actions taken by state securities regulators to FINRA. C. Only final disciplinary actions by FINRA against an associated person must be reported. D. Firms must report any disciplinary action that results in a monetary fine greater than $5,000. Answer: B. Firms must report disciplinary actions taken by state securities regulators to FINRA. FINRA Rule 4530 requires member firms to report certain events to FINRA, including disciplinary actions taken by other regulatory bodies, such as state securities regulators, against their associated persons. This ensures that FINRA has a comprehensive record of an individual's disciplinary history across jurisdictions. For instance, if a state securities board suspends a representative's license, the firm must report this to FINRA. This broad reporting requirement helps maintain the integrity of the securities industry and protects the investing public. Question 21. A principal is reviewing a firm's records. How long must a broker-dealer generally retain records of customer complaints? A. 1 year. B. 3 years. C. 4 years. D. 6 years. Answer: C. 4 years. FINRA Rule 4513 requires member firms to keep records of all written customer complaints for a minimum of 4 years. This retention period allows regulators to review the firm's handling of complaints and ensures that a complete history is available for oversight purposes. For example, if a complaint was received in 2023, the firm must keep the related records until at least 2027. Proper record-keeping is essential for compliance and demonstrating the firm's adherence to supervisory responsibilities. Question 22. Which of the following best describes the principal's role in supervising activities related to private securities transactions, selling away? A. The principal must only be notified if the associated person receives compensation for the transaction. B. The principal must provide written approval for the transaction if the associated person is to receive compensation. C. The principal has no supervisory responsibility if the transaction is executed away from the firm. D. The principal must prohibit all private securities transactions by associated persons. Answer: B. the principal must provide written approval for the transaction if the associated person is to receive compensation. Private securities transactions, or selling away, occur when an associated person engages in securities transactions outside the regular scope of their employment with a member firm. FINRA Rule 3280 requires an associated person to provide written notice to their firm before participating in any private securities transaction. If the associated person is to receive compensation for the transaction, the firm must provide written approval and record the transaction on its books and records, treating it as if it were the firm's own business. For example, if a representative wants to sell limited partnership units for a fee, the firm must explicitly approve it in writing. This stringent rule aims to prevent undisclosed conflicts of interest and unauthorized activities. Question 23. A principal is supervising the firm's obligations regarding Reg S-P, privacy of consumer financial information. Which of the following is a key requirement of Reg S-P? A. Firms must share customer non-public personal information with third parties if it benefits the customer. B. Firms must provide customers with an initial privacy notice and an annual privacy notice thereafter. C. Firms are exempt from privacy requirements if they do not collect Social Security numbers. D. Firms must obtain oral consent from customers before sharing any information. Answer: B. Firms must provide customers with an initial privacy notice and an annual privacy notice thereafter. Regulation S-P, issued by the SEC, requires broker-dealers to adopt policies and procedures to protect the non-public personal information of consumers and customers. A key component is the requirement to provide customers with an initial privacy notice at the time the customer relationship is established, and then an annual privacy notice thereafter. This notice explains the firm's policies regarding the collection, disclosure, and protection of customer information, and outlines the customer's right to opt out of certain information sharing. For instance, the notice would detail how the firm uses customer data and what options the customer has. This regulation ensures transparency and privacy for investors. Question 24. A registered representative proposes to lend money to a customer. Which of the following is most accurate regarding this arrangement? A. It is generally prohibited, unless the firm has written procedures allowing it and the loan falls under specific exceptions. B. It is permissible if the customer is a family member, regardless of firm policy. C. It is always prohibited under FINRA rules. D. It is permissible if the firm is aware, but no written procedures are required. Answer: A. It is generally prohibited, unless the firm has written procedures allowing it and the loan falls under specific exceptions. FINRA Rule 3240 generally prohibits registered representatives from lending money to or borrowing money from customers. However, there are limited exceptions, such as if the customer is a member of the representative's immediate family, or if the customer is a financial institution regularly engaged in the business of lending money. Even in these exceptional cases, the firm must have written procedures in place permitting such arrangements and must supervise them. For example, a loan between a representative and a non-family customer is almost always prohibited. This rule protects against conflicts of interest and potential exploitation. Question 25. A principal is reviewing the training program for new registered representatives regarding the firm's policies on insider trading. Which of the following best describes the firm's obligation concerning insider trading? A. Firms must only educate employees on the definition of insider trading. B. Firms must establish and enforce policies and procedures reasonably designed to prevent the misuse of material non-public information. C. Firms are only responsible for reporting insider trading activities if they originate from within the firm. D. Firms must guarantee that no insider trading occurs within their organization. Answer: B. Firms must establish and enforce policies and procedures reasonably designed to prevent the misuse of material non-public information. Under the Securities Exchange Act of 1934 and FINRA rules, broker-dealers are required to establish, maintain, and enforce written policies and procedures that are reasonably designed to prevent the misuse of material non-public information, commonly known as insider trading. This obligation includes training employees, establishing information barriers, like Chinese walls, and monitoring for suspicious activity. For instance, a firm might prohibit employees who work on mergers and acquisitions from trading in the securities of companies involved in those deals. The emphasis is on prevention and detection through robust internal controls, rather than just defining the prohibited act.